Welcome everyone to this reflections video. We produce a quarterly in conjunction with OTC. I'm delighted to be joined by Jason Paltrowitz. But Jason, many people know you, but for those who don't, I'd give you a chance to introduce yourself and also the OTC Markets Group.
Thanks, Neil. It's always a pleasure. And I don't know that most people know me, but in any event, my name's Jason Paltrowitz. I'm the Executive Vice President here at OTC Markets Group, responsible for our global corporate services business. Briefly, OTC Markets is the largest stock exchange in the US for non-US equities. Different to the New York Stock Exchange and NASDAQ, we function primarily as a secondary market for non-US companies seeking to access the breadth and depth of U.S. investors from retail to institutional, but to do so in a way where they're not SEC reporting, Sarbanes-Oxley compliant, having to reconcile to U.S. GAAP. So it is the cost-effective, cost-efficient way to have their securities traded here in the U.S., again, without the cost and complexity of a traditional dual listing that people are probably more familiar with.
And Jason, I'm hoping that we're going to come into that in a little bit more detail later on. But if I reflect back on 2025, I think the key thing is that after years and years of narrow leadership, it paid to be diversified. And the two reasons that I think you're interested in talking about this: one, you're based in the US, and then the second is, of course, you've got your trading data. So I'd be interested to understand what's changed for the US investor. Why are we seeing this change and the move away from this sort of narrow leadership that you saw around the Mag 7?
Yeah, it's interesting, and it's kind of been a slow burn, if you will. So we kind of left 2024 going into 2025, starting to see the green shoots of US investors looking beyond the US. Certainly in markets like the UK or a lot of Europe, you really saw like an undervalued group of securities compared to the US. And the US, was viewed as a little frothy. The valuations were a little high. And the general view was maybe it's run its course a little bit and to look outside the US for some of that diversification and growth. As we kind of went through 2025 and some of the geopolitical factors, tariffs and other things, you saw that accelerate a bit more, but you also saw that in conjunction again with the U.S. markets. Although the headline was Dow Jones up and the S&P up, what you really saw were people looking more closely at it, and the S&P becoming very concentrated in 10 stocks, very heavily concentrated in AI and tech. And so if you looked at kind of the S&P 490, you weren't seeing that growth and that opportunity. And so looking at Europe, where you had these geopolitical shifts, this concentration in the US, and still this undervalued universe of companies, stocks, where there was still opportunity in traditional non-AI and non-tech businesses. I think you saw U.S. investors kind of not leaving the U.S. or getting out of, the Big Ten, but certainly taking some of their money off the table and putting it into other things to kind of diversify and de-risk themselves should situations change.
Yeah, and in terms of allocations, etc., any sense of how that's moving?
It's funny. I tell this story a lot. When I started in my career, way back when, the general consensus was if you really wanted to diversify, you should have, 10 to 15%, maybe even less, 5 to 15% of your portfolio in non-US equities, right? Big American blue chips were the way to go. I think what you're seeing now is investors that those numbers are ticking into kind of the 30, 35, maybe 40, depending. And so you're seeing, yes, the U.S. is still the leader, and the U.S. Indices continue to go higher, right? We crossed 50,000 recently on the Dow. But you are seeing that, some money coming off the table from that and putting more and more into more broad global securities to mitigate some of that risk. So I think those numbers will continue to inch up a little bit more.
Yeah, and look, I mean, the story is you were rewarded for doing that. I'm going to pull some numbers up from the quarterly piece. But the story of 2025 is that Europe ex UK was up 36%. The UK was up 35%. This is in dollar terms. Emerging markets was up 34%, all ahead of US large cap, which did well. It was up 18%, but you're getting the outperformance and being paid for the diversification. But when you look underneath that, non-US value stocks is where you really saw that growth, that 42%. And that speaks to me about people looking for that margin of safety, looking for, that valuation protection, etc. And they're finding it in droves in Europe, um, the UK, and in some of the Asian markets as well. The other thing which I think was interesting, and I thought I saw this sort of coming through in your data, was that quite a lot of this is follow. It's not speculative. These are quality names, return on capital names, etc. That people have been ignoring for so many years. That's where the capital is being allocated. And the other thing we're seeing is that we're seeing this breadth, right? It's not concentrated in one or two sectors. It's across multiple sectors. Um, so almost every European sector was positive in Q4. The materials was up, 11.7, financials up 7.9, information technology up 7.8, industrials up. So it feels like that there's broad participation. And financials did well because, the credit, I don't think growth is falling apart. I mean, go back to that moment in March 2025 where potentially on the back of the tariffs, you thought that, this could be a hard landing. I don't think we're there. And actually credit quality is improving. Banks are, balance sheets are in healthy position. And then the other side of it is, I guess, what you're seeing in the US, which is it's a market that's priced for perfection. And the Microsoft earnings that happened recently, I think, are a great example of what happened. So, on the surface, great numbers. They beat on revenue. They beat on the bottom line. Cloud crossed 50 billion, but the stock fell 7% after hours. And why? Because the whisper number for Azure was a little bit higher than what they achieved, and there was some concern about the sort of capex build as well. So I think that you're seeing that theme in US stocks, where if you're delivering great, but you're not getting that much reward. If you're disappointing, you're really getting hit by that. And I think that speaks to the sort of the trend that we're seeing of people pursuing diversification into European names. I don't know if you're seeing that in terms of when you're seeing your trading data. Is there something that's hot, etc.?
Well, look, I think to your point, right? The part of the problem with having a market like the US, which is so heavily concentrated in 10 names in kind of in essence one sector, is a burp can become something substantial. And I think in the US, that theme, although maybe not in the media or top of mind, it's kind of sitting kind of untalked about down below where, all it takes is one thing perhaps in AI or technology. We saw it recently, one announcement about an AI initiative and you saw software stocks completely fall off the map, right? It was a big event. I think investors are sensing that you just have to mitigate that risk, that it's there, something is going to happen. And so how do you do that? And so yeah, our data shows that, last year trading in European names, as you pointed out, was up 42%. In Asia, it was up 53%. And you're seeing it in the sectors that aren't sexy, if you will. So you are seeing it in European financials. In from a geopolitical sense, you're seeing it in European aerospace and defense. You're seeing it, the old. It wasn't that long ago that mining, resource, and exploration was very out of favor. That's coming back into favor again. Part of that is geopolitical macro level. Part of it is you're seeing you're seeing stocks like Tesco and Compass Group, right? Old stalwarts that are actually performing really well because investors are seeking a little bit of, and I don't mean this in a negative way to my friends at Tesco and Compass, but a little boring, right? Not so uh, volatile, and if somebody burps, the whole thing falls apart. And so I think we're seeing that across the board. Those trends continue, from last year into this year, and I think, this isn't something that I think is just a flash in the pan thing. I think we're seeing kind of the new long-term norm, as our markets kind of function in the way they're functioning.
Yeah, it's good, and it's good to see the breadth again. And talk to me about. I want to break that down a little bit because one of the things I find very valuable is you're pretty open about your trading data. You put it out on your website, etc., and it points to signals in terms of what investors are thinking about. Talk to me about the flow that you saw in terms of you know non-penny stocks, plus billion-dollar names. Where what kind of companies or what kind of flows did you see in terms of different market caps? Where was the concentration?
Well, for us, kind of the general, with somebody who doesn't really know our business, the first thought is, oh, you guys are the penny stock market. But we're actually quite the contrary. In fact, we have more non-penny stocks, given the SEC definitions, than some of our counterparts. The big growth movers for us has always been our OTCQX market, which by definition you can't be a penny stock. And so that is the home to the Roche, Adidas, Heineken's, Compass, Tesco's, right? And that's where you see the bulk of the trading. And so as our markets have evolved and as we've created markets that require disclosure, that put that disclosure out to investors, that flag risk or give investors the ability to see where stocks are, perhaps there's promotion or perhaps there's things that are happening that investors should be aware of that aren't good, right? We're out there telling investors these things. Not all the other markets in the world do that. They like the listing, but they don't want to talk about some of the bad actors. And so, as we continue to evolve our market and put that information and disclosure out there, whether it's on our website or through all of our data channels, what you find is investors more and more are shifting to those companies. And so if you look at the per security dollar volume that gets traded on our market, our OTCQX market, where the disclosure is the best, right? Where the companies are, good corporate governance, good disclosure, meeting state and federal US securities laws, they trade better than the securities that sit in our, what we call our pink limited market, where that disclosure is not up to date, where it hasn't been company verified, where there's limited engagement. And so what you see is investors are looking for opportunity out of the U.S. investors, but they want to put their money in securities that are of high quality, where they can access that disclosure and they can be comfortable that those companies are meeting all of U.S. state securities laws on our market. So disclosure matters, corporate governance matters, being investable in the U.S. matters, and the numbers prove that out.
Okay, and then I mean that to me speaks to the fact that it's typically quality names that are trading, and I want to talk a little bit more about that. But in terms of we're a London-based house, we've got a focus on Europe. If you break down, where you're seeing the most activity within Europe, so let's take the DAC region, UK, Italy, France. What was the pattern over 2025? Where was the most activity, or where was the biggest flow?
Um, we probably saw a lot of activity in the UK. Part of that was just because the UK was so significantly undervalued to the US for so long. I mean, it really was at 40%, I think, going into 2025. Um, I think we're seeing it in the DAC region, primarily Germany and Switzerland. Germany, because of some of the macro things that are happening in their economy, some of the spending and stuff going on there. The Nordics, tremendous flows into the Nordics. I view that the Nordics have really figured out the SME space. So really robust public markets for the SME space that maybe some of the other markets haven't. U.S. investors are very keen on early stage growth companies in fintech, biotech, green tech. And so you're seeing a lot of interest there. Those are probably like the top. If you look out of Europe, Hong Kong has been a tremendous market. A lot of investors looking at the quality names that are actually listed on the Hong Kong Stock Exchange, the disclosure that goes with that. So we're seeing flows into Japan and Hong Kong and Asia as well.
Okay. And then, I mean, you talked about the Nordic segue is interesting. So I want to focus on the UK, which, is, I think 2025, the FTSE 100 did well. The other indices didn't do so well. However, as we start 2026, etc., the small cap indices have really started to pick up. And there's always that feeling of, people start with the sort of larger liquid names, but then it filters down. And I think I want to use this as an opportunity to do some myth busting, because a lot of small and mid cap names feel like, okay, but they're minnows in the US market. I just wanted you to put a perspective on that in terms of, are you seeing interest in small mid cap names effectively from US issuers, etc. I would guess so, because everyone's always interested in alpha, right?
Yeah, and it is a misperception, and we love to talk about our mega cap clients, but the reality is, well, there's no reality, right? People buy the mega cap names. Where when you're an SME, when you're a European SME, you like perhaps to think that you're going to get the large institutions to come in and invest in you, but the reality is that isn't typically the case. You're too small. You don't have enough shares outstanding to meet a minimum investment requirement. Um, but your home market also doesn't necessarily have the ecosystem to support pre-revenue early stage growth. European investors tend to look more to dividend payers or for post revenue, if you will. The US investor, the US self directed investor, the smaller institution tends to be very keen on those types of names and in some of the sectors that I talked about earlier. And so if you can go public in your home market, where it's much more efficient and cost effective to be public and a national champion, but you can supplement the secondary market with the natural interest of the US self-directed investor that's looking for that alpha, that's very keen in growth opportunities. That really is a recipe for success, and certainly across our QX market, kind of at the low end, where we get a bunch of those SMEs. But even in our OTC QB venture market, you see tremendous amount of U.S. interest in those names and success. And if you think about how our markets operate, again, we're a secondary market. So much of the trading that starts because we have a US ticker actually flows into the home market. So you're actually supporting your Aquis or your AIM or your LSE liquidity by targeting that US self-directed investor that is your natural actually investor. Ultimately, it's not the large institutions when you're starting out like that.
Okay. And let me just, I think we should wrap up by just looking forward a little bit. So for me, there isn't a hard landing. The macro frame is actually generally positive. I wouldn't say that, but certainly it's muted growth, but inflation looks like it's under control. Central banks are easing. US dollar is weakening, which suggests that, US capital is going to be looking for international stocks to deploy their capital to. And we think that this diversification trend is going to continue. I think we're going to see this transition now in terms of actually companies. While there's lots of noise about AI and disruption, those companies which can actually use AI, so the Walmarts, or the equivalent of the Walmart, which is using AI to dramatically improve logistics, improve its competitive position. I think we're going to start to see that in the boring economy and margins coming through. I think there's quite an interesting play in energy. I think defense is enduring. I think financials will continue to improve. Um, and I think that your sort of big takeaway of this is not just a blip in time. This is a structural shift. Is probably the key takeaway, which is that we're only at the start of a reallocation of capital. Is there anything else that you think an investor should bear in mind as we look into 2026?
No, no, I think that's it. What I would say is, again, the U.S. is so concentrated, and there's a lot of talk about AI and the benefits. And I agree, the real economy is going to start seeing some of the benefits, but the valuations, I'm still personally skeptical. And so it's either going to come from revenue, so you're going to have to find a way to monetize this significantly, or it's going to come at cost savings. Now, cost savings to me means job loss, and the type of job loss that's kind of in not the blue collar world, but in the white collar world, and that has significant downstream impact. And so, I'm not saying that will happen. I'm saying for those valuations to be real, I'm not so sure we figured out whether or not they should be real. And so I think we're going to continue to see investors kind of a little bit of skepticism until we see, is it on the revenue side? Is it on the expense side? What does that mean? And how do I mitigate that risk, especially in a US economy that's so concentrated in that? At the same time, you mentioned, the dollar weakening. That has downstream impact because of all the European investors that were investing in U.S. stocks. The S&P, if you look at the dollar, your S&P didn't perform that well if you're a European that was investing in the U.S. And so there's reallocation that's happening there as well, which is causing downstream effects and having an opportunity for U.S. investors to take advantage there. So I do think it's just the beginning, and and good opportunity for all of us, I guess, right? Like, we're
Yeah,
happy to
absolutely.
be alive.
Yeah, absolutely. I mean, what you're speaking to is uncertainty. No one knows right now what it's going to look like, but it feels like there's uncertainty. Couple
Yeah,
that with geopolitics, etc., it calls for increased diversification, and that I
yeah,
think is what you're seeing. And well, let's wrap up there. It's been a pleasure talking to you, Jason. For those who actually want to find the OTC quarterly reflections pieces, they're available on the Edison website on our thematics section. OTC do make it available as well through their social media feeds. Jason, I hope this becomes a regular feature and that we speak once a quarter. Thanks for your time again.
thank you. I always enjoy it.